So, you want to invest in real estate, but don't have the cash for a rental property or the time to deal with clogged toilets at 2 a.m.? Well, what if I told you there's a way to invest in real estate without buying a single building and still get paid like a landlord? Today, we're breaking down REITs, what they are, how they work, and why they're one of the easiest and most powerful ways to get into real estate investing, even with just a few bucks. To begin, REITs aren't new. They've actually been around since 1960, when Congress passed legislation to make real estate investing more accessible to everyday Americans, not just the wealthy. Before then, only people with hundreds of thousands of dollars could get into real estate, but with REITs, the playing field was leveled. Today, REITs collectively manage over $4 trillion in gross real estate assets worldwide. Pretty wild, right? REIT stands for Real Estate Investment Trust. Think of it like a company that owns and operates income-producing real estate and shares its profits with investors. Instead of buying a house or commercial building yourself, you can buy shares in a REIT, which owns properties like apartment buildings, shopping malls, warehouses, hospitals, and even data centers. The type of property a REIT chooses to buy can vary. Some like to focus on particular industries, while others like to focus on a vast range of sectors. For example, the REIT Public Storage focuses on acquiring self-storage units, while Welltower focuses on acquiring healthcare-related properties. The biggest lure to investors for adding REITs to their portfolios is REITs are required to pay out at least 90% of their taxable income to shareholders, meaning you get consistent dividend income, which is oftentimes higher than the stock market average. Now you might be wondering, how do REITs actually perform compared to stocks or bonds? Historically, equity REITs have returned an average of 9 to 11% per year, putting them right up there with the stock market. And they've done this with lower volatility than tech or growth stocks, thanks to the consistent income they generate. There are two types of REITs out there, equity REITs and mortgage REITs. Equity REITs own and manage physical properties and are more common. They make money by collecting rent from tenants and occasionally selling properties once they've appreciated. Mortgage REITs, also called MREITs, don't own buildings. Instead, they invest in mortgages or mortgage-backed securities, earning income from the interest on the loans they buy up. One of the most popular REITs out there is Realty Income, ticker symbol O. It's nicknamed the monthly dividend company for a reason. They own thousands of commercial properties and pay investors every single month. It's so popular with dividend investors that it's actually part of the S&P 500. Just imagine, instead of getting rent checks from tenants, you get monthly dividends from the company that does all the hard work for you. Investing in shares of REITs comes with a lot of positives. First, cash flow from dividends. Dividends in REITs are often higher than average, ranging from 4 to 12% depending on your risk tolerance. Rental income provides steady returns over time and typically goes up with inflation year after year. Given that most rent is paid monthly, this also allows many REITs out there to pay monthly dividends instead of quarterly, which can be helpful to you if you plan on retiring early to live off these dividends. Second, appreciation. On average, you can expect property values to go up 3 to 5% per year depending on your area, oftentimes outpacing inflation. The last few years, we've seen real estate explode in price, with the median home costing $329,000 in 2020 and the median being $417,000 in 2025. When a REIT is able to sell off a property for capital gain, this often leads to the company paying a special dividend to its investors on top of its normal one. Third, accessibility. If you or someone you know has been trying to buy a home in the last few years, you would know that prices have increased substantially. Interest rates are high, and the down payments are often in the six-figure range to qualify for a mortgage. Let's also mention that buying a home on a single income is a thing of the past. When investing in REITs, you can put in as little as a few dollars to get started, with the shares being extremely liquid, meaning you could buy or sell more at any given time. Fourth, no landlord duties. This means no cleaning toilets, no dealing with tenants, no headaches, just cash flow. By now, I bet you're thinking, wow, this sounds too good to be true. Just remember, all investing comes with risk, and nothing in investing is guaranteed. Buying up properties is often done by taking on debt. When interest rates are high, like they are right now, REITs typically see a decrease in profit as a result of the increased interest they pay in the money they borrow. The income produced by REITs is oftentimes treated as ordinary income, which typically is taxed at a higher tax rate. While there are REITs out there that pay qualified dividends, like realty income, which are taxed at capital gains rates, it's not very common. Much like stocks or bonds, buying shares in a REIT means that the price can swing higher or lower with market news or volatility. REITs are a powerful tool. They offer large and consistent dividend yields, lower volatility, and accessibility. Whether you're chasing passive income, portfolio diversification, or want real estate exposure without the hassle of being a landlord. So if you're looking for an easy way to build wealth through real estate, REITs might be the perfect place to start. If you learned something new today, be sure to give the video a like. It really helps the channel grow. And if you're interested in finance, investing, and retiring early, hit that subscribe button so you don't miss out on future videos. I'd love to hear from you. Have you invested in REITs? Which ones are your favorites? Drop your thoughts in the comments below. Until next time, keep tracking those dividends and keep building that financial freedom.